Ladies and gentlemen, we need to have a serious conversation right now. It has nothing to do with chart patterns, technical indicators, or the colorful lines dancing across your trading screens. What we need to focus on is something far more fundamental, something that transcends every piece of analysis you've ever studied. We need to look at the calendar. Today is Tuesday, December 30th, 2025, and we are standing exactly 48 hours away from what will undoubtedly become the most significant structural transformation in the history of the global silver market. The clock is ticking toward midnight, not in Times Square where champagne corks will pop and confetti will fall, but in Beijing where the gates of the world's largest silver supplier are about to slam shut forever. The China export ban becomes a reality on January 1st, and if you believe the financial markets are going to wait patiently for that official moment to react, you fundamentally misunderstand how sophisticated players operate in this game. The banks, the industrial giants, the strategic planners who move billions of dollars with a single phone call are not sitting idle, marking time until some government official makes a formal announcement. The panic has already erupted beneath the surface of the visible market, playing out in dark pools and vault corridors where retail investors have no access and no visibility. What unfolded this morning in the span of less than 60 minutes was not ordinary market volatility or routine end-of-year profit-taking. What we witnessed was a coordinated systemic seizure that proves beyond any reasonable doubt that the Western financial system is racing against a clock while the Eastern physical market is literally running out of metal. At precisely 8:15 this morning, Eastern Standard Time, while most people were pouring their first cup of coffee and scrolling through pre-market futures quotes, the Federal Reserve quietly executed an emergency liquidity injection into the banking system. There was no press conference, no official statement, no tweet from any Fed governor explaining the action. They simply opened the valve and flooded $3 billion into the repo market to prevent something catastrophic from happening. At that exact same moment, halfway around the world in Shanghai, the gold exchange processed one of the largest physical withdrawal events in recent memory. You have the United States printing currency to rescue the paper derivatives market, and you have China draining physical vaults to secure industrial inventory. And these two massive operations happen simultaneously on the same morning, just 2 days before the supply chain locks down permanently. This is not coincidence. In the world of international finance, there are no random accidents at this scale. There is only leverage and the violent breaking of that leverage. There is only action and calculated reaction. What we heard this morning was the sound of the main structural beam beginning to crack under impossible stress. We are watching two completely different markets reach their absolute breaking point, witnessing in real time the divorce of the paper price from physical reality. The separation papers are being served today, and there's no reconciliation possible. On one side stands the paper system headquartered in New York, the world of derivatives and high-frequency trading algorithms, the realm of promises to pay that exist only as digital entries in computer systems. This system has become so stressed, so fragile, and so over-leveraged that it required a $3 billion emergency intervention before markets even opened, just to keep the gears from seizing completely. That is not routine maintenance. That is emergency room triage on a patient coding on the table. On the opposite side stands the physical system centered in Shanghai, the world of factories and solar panels and strategic government reserves. This system is entering a state of absolute vacuum. The players in this market are not buying silver to flip it for quick profits. They are evacuating it from the exchange, taking physical delivery, loading 40-ton pallets onto armored trucks, and moving metal into private stockpiles where it will never see public markets again. They are treating silver as a strategic asset that is about to become unavailable at any price. This is the textbook definition of a squeeze. But a real squeeze is not simply a price moving higher on a chart. A true squeeze occurs when the paper price and physical reality collide with tremendous violence, when the people holding paper contracts suddenly realize there is not enough actual metal to satisfy all the claims, and simultaneously the people controlling physical metal absolutely refuse to sell it back into the system. That collision began this morning at 8:15, and the shockwaves are still reverberating through global markets. If you are holding physical silver right now, I am urging you with absolute conviction not to let go. Do not allow the volatility to shake you out of your position. Do not let sudden price drops frighten you into selling. Do not let the mainstream narrative about market volatility fool you into thinking this is normal. What I am going to explain, using specific data points about the Federal Reserve's panic response and China's aggressive hoarding behavior, will demonstrate conclusively that the suppression game is finished. The banks are not smashing prices because they operate from a position of strength. They are not manipulating markets because they have everything under control. They are desperately hammering prices because they are terrified, manipulating markets because they have completely lost control. The system is flashing red across every warning indicator. Alarms are sounding in the overnight repo markets. Physical vaults are emptying across Asia at an accelerating pace. The West is fighting this battle with liquidity injections and paper promises. The East is fighting with the fundamental force of gravity, and in the end, the exchange rate between those digits and those atoms is about to explode into a new reality that will shock anyone not paying attention. You must understand the level of fear required to withdraw 41 tons of silver in a single day. You do not execute that kind of operation if you believe prices are heading lower. You do not do that if you think the market is well supplied and stable. You do that only when you believe there will be zero metal available tomorrow. You do that when you are in an absolute panic to hoard every ounce you can secure before the window slams shut forever. Similarly, you must understand the level of institutional fear required for the Federal Reserve to inject $3 billion on a Tuesday morning without warning. You do not take that action if the banking system is healthy and robust. You do that only when a major counterparty is approaching default. You do that when the overnight repo rate spikes dangerously and threatens to freeze the entire credit market. We are standing at the dangerous intersection of a banking liquidity crisis and a physical supply crisis, and they are feeding off each other in a reinforcing death spiral. The banking crisis is being caused by extreme volatility in the metals markets, and the supply crisis is being driven by complete distrust in the banking system's ability to deliver physical metal. It represents a death spiral for the commercial short sellers, and the countdown clock is ticking louder with every passing hour. 48 hours remain. Every single hour that passes brings us closer to the moment China locks the export gates permanently. Every hour that passes makes physical silver in the vault exponentially more valuable. Every hour that passes makes those paper contracts trading in New York increasingly toxic and potentially worthless. This is why I'm calling this an emergency alert rather than routine market commentary. This is not business as usual. The data we are witnessing today represents a system in the final stages of a critical fracture. The divergence between the paper price, which desperate short sellers are trying frantically to hold down, and the physical flow, which is exploding out of vaults at record pace, cannot persist for another week. It might not survive another 48 hours. If you are wondering why price action is so volatile today, the answer is simple. This is the sound of financial warfare being fought in real time. It is the sound of the Federal Reserve throwing $3 billion at a structural problem that money fundamentally cannot fix. You can print dollars, you can print euros, you can print yen endlessly, but you cannot print the 41 tons of silver that just left Shanghai permanently. That metal is gone from the global supply. It has been removed from the board. It has been captured by the East, and the West is left holding a bag containing 3 billion freshly printed paper dollars that are now chasing a shrinking pool of real physical assets that grows smaller by the hour. Let me walk you through the specific breakdown of that $3 billion injection, because when you see exactly where the money went, you will realize just how close to the edge the system really stands. In a normal, healthy, functioning market, banks maintain plenty of cash reserves. They lend to each other overnight without concern. They trust each other's collateral. The gears turn smoothly and quietly. But this morning, the repo market screamed in distress. At precisely 8:15, demand for overnight liquidity spiked vertically. A major entity went to the Federal Reserve window and effectively stated they needed $3 billion immediately, or they could not open for business. This represents the financial equivalent of cardiac arrest. When a bank goes to the Fed for emergency repo assistance, it means the private market has completely shut them out. It means that major institutions looked at this entity's collateral and said they would not lend against it. According to transaction data, the injection was not simply a lump sum. $2 billion was exchanged for U.S. Treasury securities, while $1 billion was exchanged for mortgage-backed securities. This breakdown matters tremendously because it reveals that someone was desperately attempting to convert their highest quality assets into immediate cash. They were liquidating in panic. They were raising emergency capital, and you only raise capital at 8:15 in the morning in absolute panic because you have received a margin call you cannot meet. This is where the silver market enters the equation directly. The commercial banks that dominate the futures market are sitting on massive concentrated short positions in silver. As price rises and volatility increases, the exchange requires them to post substantially more collateral through variation margin. When price moves violently against them, they must wire cash to the clearinghouse instantly or face default. The scenario that fits all the available data perfectly is this. A major player in the metals derivatives market woke up this morning, looked at pre-market price action, looked at the vault drain happening in Shanghai, and realized they were catastrophically exposed. The clearinghouse called demanding $3 billion to cover their risk immediately. The player did not have that liquidity readily available. They attempted to borrow from other major banks, but those banks smelled blood in the water. They saw the exposure, they recognized the risk, they refused to lend. The desperate player had no choice but to run to the Federal Reserve. The Fed, recognizing a potential systemic failure that could freeze the entire derivatives market, stepped in and printed the money. This $3 billion was not economic stimulus for the benefit of citizens. It was a targeted bailout to prevent a derivatives explosion from destroying the banking system's plumbing. While the Federal Reserve was frantically swapping $3 billion of paper for other pieces of paper, they did absolutely nothing to address the fundamental root cause of the crisis. The root cause is simple and unavoidable. Physical metal is disappearing from the market at an accelerating rate. The Fed did not print any silver bars. They did not magically fill any vaults. They simply handed a massive credit line to a gambler who was seconds away from losing everything on the table. The vacuum operation proves definitively that metal is trapped. The arbitrage mechanism is broken because flow moves only one direction. The West sells paper promises, while the East takes physical delivery, and there is no reverse flow to balance the equation. This 41-ton withdrawal represents the ultimate vote of no confidence in the paper price. Chinese buyers look at $75 and laugh at the obvious manipulation. They know it is a complete lie. They are happy to pay $80 or $85 just to secure metal into their physical possession before January 1st. They are paying what can only be described as a panic premium, essentially declaring they do not care what the manipulated chart displays. They care exclusively about having actual bars in their warehouse before the export gates lock permanently. To truly understand why the price sits at $75 instead of $100, we must examine the casino floor in New York. In a single trading session today, the futures market traded 276,000 contracts. Each contract represents 5,000 ounces of silver. The mathematics are staggering. 276,000 contracts multiplied by 5,000 ounces equals 1.38 billion ounces of silver traded in approximately 6 hours on a Tuesday in December. That volume represents nearly 2 full years of global mining production allegedly changing hands in a single day. Do you genuinely believe 2 years' worth of silver physically changed hands today? Of course not. It is pure fantasy, a digital illusion created by high-frequency algorithms trading the same paper contracts back and forth thousands of times per second, generating a manufactured storm of fake supply designed to overwhelm and drown out genuine physical demand. But here's the statistic that exposes the complete fraud. Out of that ocean of 1.38 billion paper ounces traded, how many contracts actually resulted in delivery notices where the buyer demanded physical metal? Exactly 69 contracts, which equals 345,000 ounces. The leverage ratio becomes crystal clear. For every 4,000 ounces of paper silver sold on screens today, only 1 single ounce of physical silver actually moved. This is not a legitimate market. This is an obvious fraud, a fractional reserve scheme that dilutes the price by flooding the system with 4,000 claims for every 1 bar that physically exists. They are printing fake tickets for a stadium that remains virtually empty. And basic economics dictates that when you flood supply with counterfeits, price collapses artificially. But the stadium itself, the physical vault, grows emptier by the hour regardless of how many fake tickets they print. This fraud is exactly why the physical market has finally decided to divorce the paper market completely. The two prices are splitting apart in what historians will recognize as a historic bifurcation. While paper trades at $75, physical closes in Shanghai at over $80. That 7% spread is a screaming signal that the market has broken fundamentally. The paper price of $75 is a zombie price, existing only in the algorithms and on screens. It is the price of a contract leveraged 4,000 to 1 that means absolutely nothing in the real world. The physical price of $80 is the real price, the price of an actual asset being hoarded by a superpower for strategic purposes. The industrial buyers understand perfectly that a paper contract has no conductivity. You cannot install a futures contract inside a solar panel. You need the actual metal, the physical atoms, and they are willing to pay massive premiums to secure those atoms before supply They know they are massively short. They know the metal has vanished from vaults. They might attempt one final desperate price smash to trigger stop losses and panic selling. They might use paper leverage to drive price down to $72, specifically to scare holders out of positions. They desperately want your physical metal because they have none themselves. They need you to panic sell so they can cover their 4,000 to 1 leverage ratio. But you must not blink. You must focus on the data rather than the manipulated price on screens. The data says 41 tons left the vault today. The data says the Federal Reserve is terrified. The data says inventory in Shanghai has hit a historic low of 755 tons. That is the truth. The price on your screen is the lie. We are witnessing the death of the paper game that has controlled silver prices for 4 decades. They suppressed prices by trading paper contracts they never intended to deliver, protecting the dollar by keeping precious metals artificially cheap. But that game requires physical metal to provide credibility. You need a small amount of truth to sell a big lie. Today, the truth ran out. China took the last of the available truth, and now all that remains is the naked lie. When the market truly realizes that paper contracts have become worthless because vaults are empty, the rush for exits will be absolutely biblical. It will not be a slow, measured rise to $100. It will be a no-offer market where you call dealers to buy silver and they simply tell you they have none available at any price. This is your final call to action. If you hold unallocated silver in a bank account, get it out immediately into physical possession. If you do not physically hold it, you do not truly own it. Today's repo panic proves that counterparty risk is absolutely real. If a major bank can fail at 8:15 in the morning, your unallocated account can freeze at 8:16. If you are considering buying, understand the window is closing rapidly. Premiums are already rising. Dealer inventories are thinning dramatically. And if you are currently holding physical metal, stand absolutely fast. You are the smart money. You purchased the insurance before the house caught fire. You are holding the one asset the Federal Reserve cannot print and that China cannot live without. The next 48 hours will determine the winners and losers of the next decade. The losers will be those holding paper promises from bankrupt institutions. The winners will be those holding physical reality in their possession. The transfer of wealth is happening right now in real time. The Federal Reserve printed the money. China took the metal. The only question that matters is which side of this historic trade are you on as the countdown reaches zero and the export ban arrives.